So we've created a parallel financial system. So let's call that crypto land. In the other world, which we can call fiat world, we have this massive but broken financial system, and people still having to seek returns, and returns have generally been subpar for many in that, and it's difficult to participate. So this new economy, I think of it like an emerging economy, crypto land. So how do economies work? GDP growth is driven by population growth, productivity growth, and debt growth. Those are the three components that make GDP grow. So when you go to the fiat world, we've got aging populations and in many countries shrinking. We've got low productivity that may get changed by AI and other stuff, but it's still yet to be proven. But the old population is less productive. And debt growth stopped essentially in 2008. And all new debt growth is really just servicing of old debts. When we go to this new emerging economy, we have population growing at 100% a year, which is the number of active wallets. If you think of it, it had a massive recession in crypto land in 2022, and the population grew 42%. So it's like, okay, this is an amazing thing. So obviously GDP growth is faster. Productivity growth keeps increasing. Things like smart contract was a new increase in productivity for crypto land. Let's say compressed NFTs, maybe what Solana's doing with Fiat, maybe ZK proofs, all these things are productivity increases. And then debt growth, well, we've just wiped out the debt from the last cycle, so we're going to rebuild debt again this cycle, because that's what humans do. They love a bit of debt. So now what you've got is this new digital economy that's not easily accessible to everybody. Not everybody's got a passport to go there. And then you've got this fiat world. And what this ETF is a trade agreement that fiat world people can go and invest in crypto land without having to be a native. They don't need a wallet. They don't need to self-custody. They don't need any of this stuff that we all go through every day as part of our lives because we're citizens over there, but they're not. But what they've got is a free trade agreement. So free trade agreements really are all about where do I get my highest return on capital? So people want to do free trade agreements with India because it's a growing population, large economy. It's the same thing. Fiat world will be saying, well, am I going to get a higher rate of return over in crypto land? In which case, I'll put some of my money at work there. When people think of it like that, it's just an emerging market that's opening up for people to be able to invest.
Over time, in particularly the last 24 months, you've seen Switzerland, Germany, France, England, Canada, a jurisdiction that cooperates with regulators in the US in total harmony, launch ETFs with their primary asset being Ethereum and Bitcoin. So the tonality of that regulatory environment has changed dramatically. You're starting to see the regulator, talking about, let's discuss these asset classes, let's get into a dialogue about it. The reason they haven't done it yet is not because they're having a debate about whether they want to. They want to. But they have a compliance department that includes an ESG committee, which determines which assets get to the investment committee first, because every single asset is viewed by the merits of sustainability. And so just, at Bitcoin 2021, there was a huge debate going on. Elon Musk was involved. I'd made some statements about it because I'd learned from the pensions that they weren't going to get involved in it because it was not ESG compliant. The Chinese were burning coal to make electricity, to mine and get awarded coins. The reason Bitcoin is still not yet an institutional product is we have not got around this issue of sustainability. When you meet an ESG committee, okay, that's sitting on top of the investment committee of any institution, and they even have ethics committees now because they don't want to invest in places where human rights are abused. There's all kinds of these filters coming in. You can have a discussion about how many fairies dance on the head of a pin with an ESG committee, but it doesn't matter if they don't agree. And so what they want to know is, are hydrocarbons being burnt in the creation of the energy used to get a coin awarded, all right? Mm-hmm. Yes or no. Mm-hmm. Binary, yes or no. And you can't give them the theory about how it's good that there's more efficiency being built into the models for miners and their stacks and efficiencies and all that stuff. They don't give a shit. What they want to know, are you burning any hydrocarbons? If your answer is, oh, well, sort of, kind of, sort of, they just can't invest.
Where's the ESG pressure coming from?
I think you can blame Larry Fink's letter each
Okay.
year. And I think he's a genius because he sets the mandate for the global consideration at the board level of ESG.
You should probably explain who Larry Fink is.
Well, the largest asset manager on earth is BlackRock. And he writes a letter each year and he sends it to every CEO of a company he's invested in. And it basically sets the rules by which they should govern their companies regarding sustainability and climate change and all kinds of other issues that Larry believes in. Now, you can ignore it at your peril, because if he puts a position on in your company, he's going to be one of the largest shareholders, period. And so he's on a mission, and I think it's a noble one. He himself has to struggle with the definition of what ESG is, but he has changed the tonality of the S&P 500 in just 36 months. And it's global. It's global. So he will basically set a tone that disfavors non-sustainable companies and favors those that are sustainable, and they're rewarded with higher price earnings ratios. Same thing for Bitcoin. It will have a higher PE when you can say that coin was mined sustainably.
Advisors are very much paying attention to this, very anxiously awaiting it, and very excited about it. Financial advisors have been slow to the party. They have been largely disengaged from the crypto conversation of the past decade. Initially, when you took a look at Bitcoin 5 or 10 years ago, you looked at its price volatility, and it was easy to dismiss this as either a fad or a fraud. And there have been a lot of frauds, as we painfully know too well. So it was easy for a financial advisor to ignore this as beanie babies or as tulip bulbs. But over the past 5 years in particular, there has been an incredible array of development and research in the blockchain technological space. A huge amount of new applications that have risen that are useful in global commerce. We see institutional engagement at an unprecedented level, major banks using blockchain technology. We see pension funds and endowments investing in Bitcoin and other digital assets, and financial advisors have been paying attention to this. They've also been getting increasing numbers of questions from their own clients who have been seeing what's happening in the news and hearing about Bitcoin, often from their children. And the clients are asking their advisors, what is Bitcoin? Should I buy it? How much? Where do I do it? And advisors have been largely forced to say, sorry, I can't help you, because there hasn't been an effective product available to them that they can provide to their clients. Right now, according to the industry data, only 12% of financial advisors are recommending Bitcoin to their clients. So there's very little engagement. And the reason, as I mentioned, predominantly is regulatory confusion. Many advisors are prohibited. Most advisors who do engage in Bitcoin are only allocating 1 or 2, maybe 3% of assets to it. 47% of advisors personally own Bitcoin, but 77% of advisors, in the last survey we've done on this, and that we have seen others doing this, show that they are waiting for the spot Bitcoin ETF to become available so that they can provide this to their clients, because every compliance department will say okay to that product because it's just an ETF, like other thematic ETFs. The excitement rose this past summer, as you know, when BlackRock filed an application to launch one of these ETFs. BlackRock, of course, the world's largest money manager, the biggest offerer of ETFs in the country. Only once has a BlackRock ETF been denied out of about 500 ETFs that they've tried to bring to market. And after BlackRock filed their application, 10 other fund companies have done the same thing. The SEC then lost its lawsuit against Grayscale, where the court told the SEC that it acted capriciously and arbitrarily in its denial of Grayscale's request to create an ETF. So everybody's seeing the stars aligning, that everything is coming together.
They function effectively as if they're just a standalone security, but of course they can be an index, they can be actively managed or passively managed. They're kind of like a mutual fund with instant liquidity instead of like daily redemptions, right? So they're really great products.
When you buy shares of an ETF, you own the same exact investment as everyone else who owns that ETF. An SMA, picture it as an ETF with only one investor. An investment advisor would give you an SMA and can customize what it invests in. And most advisors don't know that there are now crypto SMAs. There's a world of difference between a futures ETF and a spot ETF. Futures are more cumbersome, they're more complicated, they're more expensive than buying the actual asset.
Financial advisors also, they don't put their clients into cash settled futures derivatives based ETFs, right? Advisors may, oversee the portfolios of 10, 20, 50, 100 clients at the same time, right? So they're not going to be actively, these are much more about modeling and then maybe rebalancing or like moving, changing your secular or cyclical view and then adjusting all the portfolios, right? You really can't be like day trading the Bitcoin cash settled futures ETF. Well, all of the other 19B4s, primarily for everybody that refiled in June or filed for the first time in the case of BlackRock, they're all in March, right? So the idea is like, well, why would the SEC deny in January and then approve in March? Like, what's going to materially have changed during that 2-month period? So the thinking is, well, like they would do them all by ARC's final date because that's the current first final deadline. My guess is they'd probably want to wrap this up before the holidays, if I had to guess.
The general attitude is low single digit. I argue for a 1% asset allocation. Yale did a study, and they concluded that even if you believe Bitcoin will outperform by 200% a year, you only need a 6% allocation. The CFA Institute did a report. They concluded that you should hold 2.5% to 5% allocation.
For instance, when the Bitcoin Futures ETF launched, that was the quickest ETF to reach $1 billion. It was just in a few days.
So on day one, you are going to see a significant amount of assets go in, but it's not going to sustain at that rate. You're going to get the early adopters who are going to jump in, no question about it. But what is actually more likely to occur is that it's going to take months and even years rather than days and weeks. And the reason is simply the logistic process. Compliance department has to approve the use of the product. Second, simultaneously, the investment committee has to figure out which of these 11 ETFs they want to make available to the advisors in their firms. So you've got a due diligence process going on the product while you have a compliance process going on for approval. So some will be very agile. But others, the bigger you get, the more bureaucratic you get. Wall Street wirehouses, the big national brokerage firms, JP Morgan, Morgan Stanley, Goldman Sachs, Merrill Lynch, these big, huge firms, generally, they won't approve of an ETF until it has $100 million in assets. By the time you turn around after a year or two, you're going to see massive amounts of money, tens of billions of dollars in these ETFs.
That we think there'll be 14.5 billion in inflows year one of an ETF, ultimately going to like 38 billion in year three. So not cumulative, like 38 billion of inflows in year three. That is intended to effectively be a lower bound because and I'll tell you why. It's based on the assumptions and the total addressable market that we're capturing. But first, the TAM, right? So we're starting with this top line number, which is the wealth channel. That's why I talked about it before. People with wealth have wealth managers and they don't just also separately manage a different Bitcoin position out here in some app, right? They need their advisor to have everything right there, right? So for Bitcoin to be adopted in those portfolios, or even considered for adoption in those portfolios, it has to be sitting there adjacent as an option, right? And it's that channel that I described earlier that doesn't have it. That's a $47 trillion market in the US of AUM. And we broke it down. So it's $27 trillion at broker-dealers, 11.9 at banks, and 9.3 what we call RIAs, registered investment advisors. These are all the advisors on these platforms are RIAs, but what we mean by that are independent investment advisors. These are advisors who are not affiliated with the broker-dealer or bank, but and most likely they use like Fidelity, Pershing, Schwab. All of those brokerages have white label-ish platforms that make it easy for an advisor to manage multiple sub-accounts and all that. So they're at those places. So for example, those independent RIA platforms like Fidelity has, right, where I worked for 12 years. So I know a little bit, I remember this platform. they're probably going to add it pretty fast. They'll be slower to adopt the banks and broker dealers than the independents, right? So we said only 25% of the broker dealers and banks AUM. I mean, we're using, I don't know, we don't know the number of accounts, but we'll just use AUM as the total, like, sort of addressable capital market. Only 25% will actually turn on the ability to add the ETF into a portfolio on their platform in year one, right? So that now brings down the total addressable market. So we're no longer at, for example, for broker dealers, we're no longer at 27 trillion. We're at 6.8 trillion of addressable capital in year one, right? So, and we did that for each of them. And you can see there's a graphic in the report that shows this ramp for each of the segments, right? But we said 50% of the IRA cap. So you can see that ramp up over time. What portion of that capital will actually decide to allocate something? And then how much will they allocate, right? And so for the first question, we called it average percentage of assets adding BTC exposure. And we just stayed with a flat 10 throughout everywhere. We're just saying, look, 1 in 10 decide to put in something. And then we look at, well, how much then? What is the average percentage allocation? And here we went with 1%, which we have a separate report that goes deep into portfolio Bitcoin, portfolio allocation strategies. And 1 is a good, solid number that historically has been both great from a volatility standpoint, low, right? But also can provide really good benefit to your portfolio. So I think we stand behind the percentage inflows because it's about a relationship between flows and current price. So whatever the current price is, we can rerun it and see where we get. But look, I mean, I think that's pretty, like, for example, if we took today at we'll call it 35K, love to see it, that puts us at, 26,000 higher from here. So we're up into the low 60s.
Yeah, it's very rare to be this strong this early in the cycle. Now, we are front-running some of the capital flows, and so there's probably some correction that happens by the rumor sell the fact. But I think if the space continues like this and we start getting monetary easing and the other conditions that tend to jumpstart the business cycle again, then we should see a very strong 2024 and most likely a strong 2025. The business cycles have been almost like clockwork, 2-year up cycles, 1 year peaking, 1 year down. And that corresponds. What's amazing is the Bitcoin halving cycle is the same as the debt refi cycle, which is, I think, what drives everything. It's the same as the election cycle. They're all the same thing.
As we discussed, an Ethereum ETF is likely to launch within months after a Bitcoin ETF. Do you think that's going to have a similar or different reception by institutions?
That's a good question. For retail, it's just price action, and what's likely to happen is the moment the Bitcoin ETF is launched, the market will focus on front-running the ETH ETF. If the previous front-running made money, they'll do it again. So retail will get very interested. And, ETH's a broad, deep ecosystem, and people are happy to get exposure to it. The institutions, it depends whether they give the yield of ETH in the ETF or not. If not, a lot of the institutions would prefer to own ETH itself, because then they can stake it and get yield. Because if you don't give them yield, some asset manager who launches the ETF is going to get rich. BlackRock, they'll make all the money because they'll get the ETH staking yield, and they don't give it to the ETF holder. And we've seen that very commonly in ETFs in the past. So I think that's the thing, because when I speak to institutions, they get ETH and we get a yield, so we can just sit on it.
So advisors and their clients will quickly realize, I don't know if this will be weeks or months or if it'll take longer, that there's more to crypto than just Bitcoin, and they will want to turn to other digital assets. The first natural place for them to go is Ethereum. Pretty soon, I don't know if it'll be days or weeks or if it'll be months or years, people are going to realize I should own more than just Bitcoin. In fact, some of the applications we're starting to see are for combo funds. They invest in both Bitcoin and Ethereum. Some, such as Bitwise, has a fund that invests in the top 10 digital assets. Bitcoin and Ethereum are the top 2, and then they have the next 8 largest coins.